You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right. Well, last week we took a time out to answer some listener questions. I always love when I get that opportunity to team up with Mark and do a little huddle up and answer some of your questions. Today we're going to get back into the strategies. And September and October are right around the corner. Now, everybody always says, well, the time of the year doesn't matter to volatility, but then time and time again, they prove to be very volatile months. Now, last year, December was the most volatile month, and I don't have any rationale as to why volatility may pick up at the end of the year, every year, but it just seems to do so. Now, with that being said, I think it's time to talk a little bit. The last couple of shows we talked a little bit about protection, protective strategies on stocks in particular. Now let's talk about something that wants volatility. So we've mentioned a few times Boeing. Boeing is a stock that has been in the news, a very solid company, one basically a duopoly out there that's making airplanes. And with Boeing, we always kind of said that if you're thinking about the stock being volatile, I would prefer the volatility to be unknown. In other words, if I'm going to do a strategy guessing that the stock is going to be volatile, it's not because of a known event. It's not because we know that a hurricane is coming Florida's way and I'm trying to buy insurance on my house. Well, I can't do it at this point in time because we know the hurricane is coming. At the same scenario would be if I'm looking at Boeing and I'm trying to do a long straddle, which is the show that we talked about, around earnings. Well, if that event is there, it's going to be priced in. So you want to look at companies where basically that event is unknown and you just kind of hope that it happens. Usually volatilities will have a tendency to just be higher in those underlyings. And Boeing was fairly high, but you know what? Vols had come down since the major news of the planes crashing, and yet at this point in stage, the planes still haven't flown. Even though volatility came in, there's still a major news event that's out there at some point in time. We just don't know when it's going to happen, right? So we looked at long straddles in Boeing, thought it was a flagship expensive company, though, and those trades on paper seemed to work out just fine. So I went looking for another stock that I might be interested in. And another well-known company has been in the news a lot lately. And unfortunately for them, it hasn't been good news overall. And that's General Electric, simple as GE. Now, this is an exact opposite story in that General Electric is now trading for, and the markets are open, I should mention when we're taping. Right now we are taping Options Playbook Radio on the 28th of August. The markets are open at this point in time. And I'm seeing General Electric trading right now at $7.91. So to me, there's some major news out. There's news every day. The stock has made 10% moves left and right over the last 6 months to a year. And there's no earnings. Their next earnings date is forecasted, it's not set in stone yet, to be October 30th. So we don't have the big run-up in implied volatility based off our earnings. We just have a little bit higher vols because of the stock that has been moving. We're seeing the implied volatility on a 30-day option contract on a weighted average basis is trading up around 50%. On the low end for this year, it's been down around 35%, as high as 70, it looks like 73% based off of the chart that I'm looking at right now. So we're in a medium range as far as the yearly implied volatility is. And yet we still know that there's not all the news is out on GE. And if you look at the chart, it's at a very interesting point as far as support and resistance. So why not do a long straddle in General Electric? It's the right time of year. Volatilities have came in. We still have major news. Now, here's one of the biggest things that I like way more about General Electric and long straddles than I do about Boeing, is that it's an $8 stock. And that in itself brings the premium, the prices of the option contracts down quite a bit. Now, in General Electric, it's trading, I think about 20% vol point. Don't quote me on this, but I'm thinking from my research on Boeing that it's about 20% implied volatility points higher than Boeing. But it's an $8 stock, so the options are just going to be less expensive because of the overall price of the stock. So today's paper trade, we're going to look at a couple of paper trades, and we're going to talk a little bit about the dynamics of both of them. Our long is going to be a long straddle in General Electric. The first one that we're going to look at is the September 20th expiration date. So as I mentioned today, we have the 28th. We're going to go out till September. When I'm looking for major news events, you want to give yourself as much time as you can afford, if that makes sense. You just don't want to get too expensive because then you need a bigger move in the underlying stock. But if we go out to the 20th, we have 23 days out until that expiration date. If I look at the most at the money call and put, that would be the 8-strike call and the 8-strike put. We see the call is trading on the ask at 32 cents, and the put is trading on the ask at 41 cents. 1 cent wide markets, extremely good markets, a lot of open interest, a lot of volume in general. All these things make it attractive underlying to be trading options in. So the total cost of this trade at that midpoint is 72 cents at this point in time. So 72 cents if you can fill at the midpoint, 73 cents on the ask if you can't. You're only giving up a penny. But if we look at that, that's about a 9% move. That's 72 cents on a $7.91 stock. You're talking about a 9% move to make up that 72 cents. So my research, what would I do? I'd go back and look over the last 6 or 7 months and try to avoid earnings. You don't want to look at earnings and add that into your data. But basically, I'm just doing this off the cuff, looking back and saying, gee, has this stock moved about 9%, and how many times has it done it over the last 6 to 12 months? And with General Electric, it has. It's made that move more than 6 times, and so maybe it'll do it again. Now, the timing is a big deal here, but maybe it will. So overall, if we think that in the next 23 days some major news can come out on General Electric, let's go in and let's buy a long straddle. We're going to pay 72 cents for it. We know that that's our max risk, so we have $72 of risk plus commission. Always got to add in the commission, and that will be your max risk on this trade all the way out till that September 20th expiration date. Now, Another way to look at it, though, is that maybe I want to give it some more time. And when I'm thinking of long straddles in this instance, I just kind of want to avoid earnings. Now, I don't mind if earnings is way out in time and the implied volatility in those option contracts hasn't really started to creep in, if you will, to the option prices. But with General Electric, we have the October expiration, the normal monthly October expiration, which would be the October 18th expiration, and then we jump all the way out till December. So I would maybe look at a November if they were available, but they're not. So the October 18th expiration is 91 days away. So I'll give you a second paper trade to watch this week. If you just think that you need a little bit more time, it doesn't cost you a lot more to go out 51 days as opposed to doing the September option contract that we talked about that is only 23 days away. So if we look at the long straddle with the October 18th expiration, we're talking about $1.07 for that option contract. If we buy it on the ask right now, that is trading for $1.07. The midpoint, once again, we got 1 point spreads, is $1.06. So that means, once again, if I pay that ask, I'm paying $107 plus commission to buy my 1-by-1 long 8-strike straddle with the October 18th expiration. So that's about 11 or 12% expected move. Now, the stock has made those type of moves also. So I just find it interesting in a stock like General Electric that's been in the news a lot lately, a lot of volume. If you even just look at total volume in options on underlying stocks, General Electric has been in the top 10 for quite some time now. So you're getting tight markets, you're getting a lot of volatility overall. The long straddle is interesting, and a lot because General Electric is trading at $7.90, and that brings down the cost of the options overall. Okay, so the two paper trades for this week, let's just review. We went in and just talked about long straddles, and we'll talk a little bit about maybe adjustments and what we can do once we get the trade on. But the first long straddle we looked at was the September 20th expiration, buying the 8-strike put and buying the 8-strike call. At the natural, it would be 73 cents. That would be $73 plus commissions in order to place that trade, and that would be your max risk. And obviously, your upside is unlimited on the call side and basically substantial on the put side if the market starts going down. And then if we look at the October 18th expiration, right now we're talking about $1.07. That's $107 plus commission in order to go out further in time and give yourself 51 days out until that expiration date. Now, if I'm trading this, what I really want to make sure that I do is I don't mind, especially when you have time, legging out of the straddle. In other words, I'm not doing this around earnings where I just have the event, the news comes out, I'm going to get out of the trade because the event created the movement in the underlying stock. Now it's made the move because of the event, so let's just close this trade and get out and move on. In this instance, I kind of prefer to leg out of it in that if I get the move to the downside, enough to actually pay for the long straddle and maybe even give me a few extra cents, I just sell the put option and remain long the call, especially if it happens early in the life of the trade. If I get the type of move early, no problem legging out of one side. Now, my only thing is I want to make sure that if I am going to leg out of the put because the underlying stock started to go down, I want to make sure that it pays for the trade. I don't want to be legging out of this trade. And if I look at the September expiration, the September 20th expiration, we're talking about 73 cents. I'm not going to get out of that trade until I can at least make 73 cents on that put. I want to be able to pay for the long straddle. Now, ideally, I would like to make a little more than that 73 cents overall. I would like to be able to sell it for maybe 80 or 85. But in general, that's not a bad way to trade it, especially if the move happens early. And that is even more true if we have more time, right? If we look at the October 18th expiration, then yeah, definitely have no problem legging out of that trade and waiting for maybe some more news that might surprise the market up until that expiration date. Now, lastly, before I sign off on our discussion, another thing that we can do is if the market does go in one direction, you can leg into a long put spread, sell some premium, give yourself a little bit more on the downside, take some money off the table. Or on the call side, if it starts going up, you can leg into a long call spread and keep that position on. But by doing that, you're not selling the call that you have. You're just going to be selling an option contract that has increased in value since you put on the trade, and you're going to create a long call spread or a long put spread that can still benefit if the market continues on down. That's another way to look at this. So long straddles, if you can find the right underlying, are interesting to do. Now, keep in mind that long straddles over time are a real tough trade to make money time and time again. You really need to pick your underlyings well and have your rationale behind getting in the long straddle because you're just paying so much in time premium and you're getting such large rates of time decay and theta decay over time. But I like the time of the year. I like what's going on as far as the news is concerned and how often GE is in the headlines. And I also like the price of the stock. So over time, a long straddle is interesting only because of the news that's going around in the underlying. I have no opinion on General Electric whatsoever as to what's going to happen to it, but the long straddle allows me to not have that opinion. My only opinion is that the stock is going somewhere. All right, that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, you can send them to me directly at theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.